Hello, Kathy Waite here, your net worth manager, fee only financial planner and money coach. I often get inquiries, people get in touch saying, I've done what my advisor has told me to do and I'm still making no money. So today we're going to talk about different types of investment strategies and try and shed some light on that. There are 3 more short videos in this series. The second is going to be about the proof of what I'm telling you today. The third will explain why you should care, and the fourth, what you can do to get more out of your money. So to get started, different types of investment strategies that are available. Well, broadly speaking, you can be an active investor or a passive investor, active or passive. Passive is also sometimes referred to as indexing. Active means that you or your advisor or stockbroker pick individual stocks and bonds, or you choose an investment fund whose manager is going to do that on your behalf. Active management is based on the belief that you can beat the market, you can pick the winners and avoid the losers. You can figure out when's a good time to get in and when's a good time to get out. Passive investing, also known as indexing, is when we seek to track the performance of an index that represents a broad market instead of individual stock picking. We buy the market, we don't buy individual stocks or positions as they're sometimes called. Jack Bogle, the founder of Vanguard, put it very well when he said, "Stop looking for the needle in the haystack and buy the whole haystack." Most funds in Canada take an active approach to investing. So with all this talk about indexes and benchmarks, what exactly do I mean? If you think about what you hear on the news, the TSX is up. The market closed down today. The TXX was down, except for banks, which were up. What they're referring to is a list. It's a basket of the biggest companies in Canada or the US. So without knowing it, you're actually likely quite aware of what an index is. You are hearing it reported all the time. So there can be many different types of indices. Some are very specialised and you probably wouldn't use them for your retirement planning because they could be quite volatile. They might be outside of your risk tolerance. So that's things maybe like the NASDAQ or the Dow Jones, some names that get thrown around. And what we usually want is to minimise risk, to smooth out our returns. We want to diversify. We want some upside, but to minimise the downside. So to spread the risk, we stick to the biggest companies in the country, and that's called a market cap index. It means that we own more of the bigger companies and less of the small ones, for obvious reasons of safety. So then, active is about guessing which stocks will win, selling and buying at the right time. Indexing emphasises broad diversification, limited trading, and aims to keep costs low. In indexing, you don't make any bets about individual companies or about bonds. We buy the entire index, the list, the basket, or the haystack. Call it what you want to, but there's no guessing. So that's the difference between active and passive. So the next video is going to be the proof of this. Standard & Poor's published some really good research that I will share with you. So as always, feel free to email me or send me a video from your phone that tells you what you think about this. Have a good day, but remember, plans before products, and no one cares more about your money than you do, so it pays to be informed.